Lesson number 10. Banks and Simple Interest. A bank is a government-recognized institution that carries out transactions of money. Banks make it easier to plan the use of money, that is, to do financial planning. We can either deposit cash money in a bank or withdraw cash from it. For that purpose, we must open an account in a bank. Bank accounts are of various kinds. Current account. A current account is mainly for traders and those dealing in money on a daily basis. An account holder can deposit or withdraw money any number of times in a day. The bank issues a passbook for this account and also a checkbook on demand. The bank does not pay any interest on the money in this type of account. Money can also be withdrawn or deposited by check. Savings account. A person can deposit a minimum amount and open a savings account. In some banks, no minimum amount is required for opening an account. The bank pays some interest on the basis of the daily credit balance in the account. There are some restrictions on how often money can be withdrawn from this account. For this account too, the bank issues a passbook and on demand a checkbook. Recurring deposit account. The account holder can decide the amount to be deposited every month in the account. The bank gives an interest on the deposit, which is more than that paid for the savings account. Such an account is a means of compulsory savings. Often, it is convenient to have a joint account for, say, husband and wife, or guardian and ward, etc. Besides, accounts of business partners, housing societies, trusts of voluntary agencies, etc. are required to be operated by more than one person. Fixed deposit. A depositor deposits a certain amount for a fixed period in the bank. This deposit attracts a greater rate of interest than the savings account. However, these rates are different in different banks. Senior citizens get a slightly greater rate of interest than the usual. ATM, credit and debit cards. An ATM, automatic teller machine, card is used to withdraw cash without going to a bank. A credit card or debit card is used to carry out transactions without using cash. An account holder can get such a card on request to the bank. Have you seen a bank passbook? Observe the entries made in the page of a passbook as shown below. Number, date, particulars, check number, amount withdrawn, amount deposited, balance. 1. 2nd February 2016. Cash. 1500, 7000. 2. 8 February 2016. Check. 232069. 5000. 12,000. 3. 12 February 2016. Check. 243965. 3000. 9000. 4th. 15 February 2016. Self. 1500. 7500. 5. 26 February 2016. Interest. 135. 7635. On 2nd February 2016, the amount deposited was rupees 1500 and the balance 7000 rupees. On 12 February 2016, rupees 3000 were withdrawn by check number 243965. The balance was 9000 rupees. On 26 February 2016, the bank paid an interest of rupees 135. A passbook is issued for a savings account and a recurring deposit account. Amounts deposited, withdrawn and the balance are recorded in it with their dates. Suvidha borrowed a sum of 30,000 rupees at 8 PCPA, interest for a year, from her bank to buy a computer. At the end of the period, she had to pay back an amount of 2,400 rupees over and above what she had borrowed. Based on this information, fill in the boxes below. Principal equals rupees 30,000. Rate of interest 8%. Interest rupees 2,400. Time 1 year. The total amount returned to the bank is equal to principal plus interest is equal to amount. Means 30,000 plus 2,400 is equal to 32,400. Now, we will see another type of example. Neha took a loan of 50,000 rupees at 12 PCPA to buy a two-wheeler. What amount will she return to the bank at the end of 1 year? The amount, that is the total money owed to the bank at the end of the time, is to be calculated here. The principal is 50,000 rupees. At 12 PCPA, the interest on 100 rupees for 1 year is 12 rupees. We shall write the ratio of interest to capital in two ways to obtain an equation. On 50,000 rupees, let the interest be x rupees. On 100 rupees, the interest is 12 rupees. X divided by 50,000 is equal to 12 divided by 100. Hence, x divided by 50,000 into 50,000 is equal to 12 divided by 100 into 50,000, multiplying both sides by 50,000. Amount to be returned to the bank is equal to principal plus interest. Made rupees 50,000 plus 6,000. Therefore, amount to be returned to the bank is equal to 56,000 rupees. Now, as per the book, you try to solve other examples and practice it more.